Hi there, it's Friday the 18th of October 2019. I'm Steve Towers. Welcome to ITB. Let's get started. The OECD's unified approach under Pillar 1 has received mixed comments from developing countries this week. For example, the African Tax Administration Forum, ATAF, has issued a generally favourable opinion on the unified approach and also on the Pillar 2 proposals. However, the ATAF opinion rejects the adoption of mandatory binding arbitration, which is one of the elements of the unified approach. For a copy of the ATAF opinion, please go to our website or app. And negative views were expressed at a conference yesterday by Colombia's delegate to the G24 group of developing countries. He was reported as identifying 3 weaknesses with the unified approach. Firstly, he disagreed with the distinction between routine returns and residual profits, which he described as totally artificial in the context of a multinational group. Secondly, the unified approach should not be limited to large multinational groups. And thirdly, the use of sales as the only allocation factor is criticised. Other factors, such as employment, digital users, and natural resources should also be used. In France, the tax authorities have published guidance in regard to the DST. For a copy of the guidance, please go to our website or app. As I'm sure you know, the UK government and the EU have reached an agreement for Brexit to occur on the 31st of October. However, the critical issue now is whether the House of Commons will endorse the agreement tomorrow, the 19th of October. At the present time, due to the stated opposition by the DUP, the numbers are said to be very close. The key aspect of the agreement between the government and the EU is, of course, Northern Ireland, and in particular, the customs and VAT arrangements. These are described in the revised protocol on Ireland and Northern Ireland. For a copy of that revised protocol, please go to our website or app. There has been a positive development in the China-US trade war. After a week of negotiations, the two countries have indicated that a so-called Phase 1 agreement has been reached in principle. The Phase 1 agreement is stated to be the first step towards a more comprehensive trade agreement between the two countries. The Phase 1 agreement is pending a formal write-up, which is expected to take up to 5 weeks. It might be signed at the APEC meeting in Chile in mid-November. It's understood that the 2 key elements of the Phase 1 agreement are, firstly, a commitment by China to purchase up to $50 billion of US agricultural products. And secondly, the US's 5% tariff increase scheduled for the 15th of October has been suspended indefinitely. Meanwhile, the US's additional tariffs on imports from the EU, recently authorised by the WTO, were scheduled to start today. For the original list of additional tariffs and a subsequent list of adjustments, please go to our website or app. And the OECD has released a report called Taxing Energy Use 2019. The report reviews 44 OECD and G20 countries in regard to their energy and carbon taxes. For a copy of this report, please go to our website or app. In Australia, the High Court, which is the country's highest appellate court, has decided a revenue versus capital deduction case against the taxpayer. This was an appeal from the full federal court decision in September 2018. The taxpayer, which carried on a hotel business, incurred expenditure on acquiring a 10-year gaming machine entitlement for each of its slot machines. The expenditure was paid by instalments. The High Court held that the expenditure did not qualify for deduction. For a copy of this case and a summary prepared by the court, please go to our website or app. Also in Australia, the tax authorities have issued guidance in regard to GST compliance for certain credit card and charge card issuing businesses. For a copy of this guidance, please go to our website or app. And now to India, where I have two cases for you. The first case is called Merrill Lynch Capital Market. It's a decision of the Mumbai Income Tax Appellate Tribunal, and it concerns the other income article, which is Article 23, in the India-Spain Treaty. Importantly, Article 23 is effectively in the same form as Article 21 of the UN Model Treaty. It therefore contains the troublesome Paragraph 3. Notwithstanding the provisions of Paragraphs 1 and 2, items of income of a resident of a contracting state not dealt with in the foregoing articles of this convention and arising in the other contracting state may be taxed in that other state. This is troublesome because it can encourage the source country tax authorities to apply a narrow interpretation of Article 7, the business profits article, and conclude that a particular item of income derived by a company which carries on a business is not dealt with by Article 7, which then enables Paragraph 3 to allow unlimited source country tax, even though there is no PE. And that's exactly what the Indian tax authorities did in this case. The taxpayer is a Spanish resident company and a foreign institutional investor under India's regulations. It does not have a PE in India. The taxpayer entered into some forward foreign exchange contracts from which it derived some profits. The tax authorities took the view that under the FII regulatory regime, the taxpayer was not permitted to enter into those contracts. Therefore, they said, the profits derived from those contracts cannot be profits of an enterprise, and thus Article 7 does not deal with the profits, which allows Article 23(3) to apply. The tribunal rejected that argument. It held that, with or without regulatory approval, the profits derived from the contracts are profits of an enterprise, and thus Article 7(1) provides an exemption from Indian tax. The second case is called Becton Dickinson. It's a decision of the Authority for Advanced Rulings, and it concerns the exemption from Indian capital gains tax on share transfers under the India-Mauritius Treaty prior to the 2016 Protocol and the introduction of GAR. The taxpayer is a Mauritius company with a global business license number 1 within a US-owned global group. The Mauritius company owns 100% of the shares in an Indian company. It had held those shares for 15 years. As part of a global restructuring, the Mauritius company transferred all of its shares in the Indian company to a Singapore company, which was a 100% member of the global group. The transfer was for market value consideration. The issue in the case was whether the Mauritius company could rely on the exemption in Article 13 of the India-Mauritius Treaty. The Mauritius company held a Mauritius tax residence certificate and did not have a PE in India. It therefore satisfied the express conditions in the treaty. However, the tax authorities put forward a number of alternative arguments. Firstly, the tax authorities argued that the Mauritius company was a Benami shareholder on behalf of the US parent. In other words, a mere nominee holding the shares on behalf of the US parent. Secondly, the tax authorities argued for the application of the common law anti-avoidance doctrine as discussed in the Supreme Court's Vodafone decision in 2012. Both of these arguments were rejected by the AAR based on the facts, and therefore the AAR ruled that the Article 13 exemption applies. For a copy of these two Indian cases, Merrill Lynch and Becton Dickinson, please go to our website or app. In Malaysia, the government has presented its 2020 budget. The budget contains a long list of new and extended tax incentives. Two of the new incentives caught my eye. The first is that an income tax exemption will be given for up to 10 years for income from patents and software, to the extent that the modified nexus approach in BEPS Action 5 is satisfied. And the second is a pair of two incentives for electrical and electronics companies to transition to the 5G digital network and Industry 4.0. One of the incentives is an income tax exemption for up to 10 years, and the other is an investment tax allowance of 50% on qualifying capital expenditure. I have 4 cases for you from the European Court of Justice, 1 on the freedom of establishment and 3 on VAT. I'll start with the freedom of establishment. The freedom of establishment case is called Argenta Spaarbank. It concerns a Belgian company with a PE in the Netherlands. The profits attributable to the PE are exempt from Belgian income tax under the Belgium-Netherlands double tax treaty. The Belgian company claimed a notional interest deduction for Belgian tax purposes. Under the Belgian tax law, the amount of the notional interest deduction is reduced by reference to the amount of tax-exempt profits derived by the Netherlands PE. The issue in the case was whether that reduction breaches the freedom of establishment in Article 49 of the Treaty on the Functioning of the European Union. The court held that the reduction does not breach the freedom of establishment. For a copy of this decision, please go to our website or app. The first VAT case is called Unitel. A Polish company, according to its invoices, sold goods to 2 Ukrainian companies. As Ukraine is outside the EU, the Polish company reported the sales as zero-rated exports. It also claimed input tax credits for the related inputs. However, the tax authorities discovered that the goods were not actually acquired by the 2 Ukrainian companies stated on the invoices, but instead by other unidentified entities. The court held that in these circumstances, the Polish tax authorities cannot automatically deny the zero rating and the input tax credits. Instead, they can do so only if the failure to identify the actual acquirer prevents it from being proven that the sale is an export transaction, or the Polish company knew or ought to have known that the transaction was part of a VAT fraud. For a copy of this decision, please go to our website or app. The second VAT case is called Paulo Nascimento Consulting. The taxpayer is a Portuguese company which is a real estate agent. The taxpayer was owed money by a client. it commenced enforcement proceedings against the client in a Portuguese court. The taxpayer then transferred to another company all of its rights and obligations under the enforcement proceedings in return for a payment. The issue in the case was whether that transfer qualifies for VAT purposes as an exempt supply on the basis that it concerns the granting, negotiation, or management of credit. The court said no. For a copy of this decision, please go to our website or app. And the third VAT case is actually two joined cases in regard to the VAT treatment of a service of formally serving court or administrative authority documents. The court held that the service provided by two private sector companies was exempt from VAT. For a copy of this decision, please go to our website or app. The European Commission has published its monthly infringements package for October. There are only two tax matters worth noting. Firstly, the Commission has sent a reasoned opinion, which is the second level of Commission action, to Italy for failure to transpose into national legislation measures on VAT obligations for suppliers of services and distance sales of goods. And secondly, the Commission has sent a letter of formal notice, which is the first level of Commission action, to Germany in regard to its VAT legislation concerning online marketplaces. The Commission objects to the legislation's requirement for a paper certificate, which the Commission describes as an inefficient and disproportionate measure. For a copy of the October infringements package, please go to our website or app. In Germany, the government is starting to implement its Climate Protection Programme 2030, which was released in September. This week, the government has approved a draft bill which will significantly increase the country's aviation tax, with the increases being proportionately higher for short-haul flights. The increases will be effective the 1st of April 2020. Please hit the pause button if you would like to study the new rates. In Greece, the government has presented its 2020 budget, which includes the tax reductions previously announced and confirmed. Most significantly, a reduction in the corporate income tax rate effective in 2019 and a reduction in the dividend withholding tax rate effective in 2020. For a copy of the government's budget statement, please go to our website or app. In Italy, the government has presented its 2020 budget. There are two notable aspects. Firstly, the government has managed to avoid triggering an automatic VAT rate increase for violation of EU deficit reduction targets. And secondly, the 3% digital services tax is included. This will operate from the 1st of January 2020. In Luxembourg, the government has also presented its 2020 budget. One item has attracted some attention. Private tax rulings which were issued before 2015 and are not stated to have any expiration date will cease to be valid after the 2019 tax year. In Portugal, the transfer pricing rules have been amended with effect from the 1st of October 2019. The most significant change is that taxpayers which are under the large taxpayers unit will be required to file their annual TP documentation by the deadline for filing their corporate income tax return. In the UK, the upper tribunal has decided a case in regard to the calculation of profits attributable to a PE under the Business Profits article of the Ireland-UK Double Tax Treaty. Importantly, this case concerns an Irish bank with a PE in the UK, and it focuses on the determination of the amount of deemed equity or free capital in the PE. Under a provision, Section 11AA, which was inserted into the UK domestic tax law in 2003, a number of directions are given as to how to calculate the profits attributable to a PE. The relevant parts of Section 11AA state this. 2. There shall be attributed to the permitted establishment the profits it would have made if it were a distinct and separate enterprise, engaged in the same or similar activities, under the same or similar conditions, dealing wholly independently with the non-resident company of which it is part. 3. In applying subsection 2(b), it shall be assumed that the permanent establishment has such equity and loan capital as it could reasonably be expected to have in the circumstances specified in that subsection. The facts in this case occurred after 2003, and so therefore Section 11AA was applicable. However, the taxpayer argued that that section, and in particular paragraph B of subsection 3, was contrary to the Business Profits Article, Article 8 of the Ireland-UK Treaty, and therefore it cannot be applied. Instead, said the taxpayer, the actual amount of capital employed by the PE should be used for the calculation of the profits attributable to the PE, not a notional amount determined under Section 11AA. And so the issue in the case, according to the tribunal, was whether the treaty required a different outcome to that mandated by Section 11AA, or whether the treaty could be read or applied consistently with Section 11AA. A key part of the taxpayer's argument was that for many years prior to 2003, the practice of the UK tax authorities was to use the actual amount of capital employed in the PE, not a notional amount. Therefore, the taxpayer said, the two contracting states, Ireland and the UK, must have intended that practice to be used for the purposes of the treaty. The tribunal rejected that argument on the basis that the unilateral practice of one contracting state, in the absence of evidence that the other contracting state agreed with that practice, cannot influence the interpretation of the treaty. The Ireland-UK Treaty was signed in 1976. At that time, the 1963 OECD Model Treaty and Commentary were current. The tribunal decided to give weight to that version of the Model Treaty and Commentary, but little weight to documents which were issued after 1976. Based on the 1963 Model and Commentary, the tribunal concluded that Section 11AA is consistent with the treaty. We do not say that Section 11AA(3)(b) is the only way in which the Business Profits Article of the Convention could be implemented, but this manner of implementation is, we hold, entirely consistent with and permitted by the terms of the Convention. And the UK's upper tribunal has decided a VAT case in regard to a moon mission. I'm not kidding. The taxpayer, Lunar Missions Limited, offered rewards to supporters who pledged funds through a crowdfunding platform to fund a project to send an unmanned spacecraft to the moon to undertake scientific research. A supporter who pledged funds was offered rewards in the form of digital and/or physical space in a capsule that would be buried on the moon by the unmanned spacecraft. The issue in the case was whether the taxpayer made a VAT supply to its supporters at the time at which the pledges made by the supporters became unconditional and the taxpayer received payment. The tribunal held that, yes, a VAT supply was made at that time. For a copy of this case, please go to our website or app. In Kenya, the VAT law has been amended to allow excess withholding VAT credits to be set off against other tax liabilities, such as corporate income tax and withholding tax, and then, if there's still an excess of credits, to be refunded. This will be of significant benefit to companies, many of which have carried WHVAT credits indefinitely. And now to Mexico. You'll recall that in Mexico's 2020 budget, VAT and income tax collection obligations will be imposed on non-resident digital service providers and non-resident digital platforms. Well, 9 US technology associations have written to the US government criticizing those obligations and urging it to engage with your Mexican counterparts to discourage them from proceeding with the proposal. For a copy of the letter, please go to our website or app. In Paraguay, a major income tax reform has been enacted. Commentators expect that the effective date for the changes will be the 1st of January 2020. Several items caught my eye. Firstly, the 2 previous income taxes on business activities have been abolished and replaced by a single business income tax, which will carry a 10% rate. I've noted 2 interesting aspects of this new business income tax. It will be imposed on individuals, legal entities, and transparent legal structures, such as trusts, investment funds, and risk-sharing contracts. And taxpayers will be allowed to carry forward tax losses for 5 years, but the loss utilisation in each year will be capped at 20% of taxable income. Secondly, transfer pricing rules based on the OECD guidelines have been introduced. And thirdly, a 15% dividend withholding tax will apply to dividends paid to non-resident shareholders. As a transitional measure, a 10% rate will apply to dividends paid in 2019 from profits generated in preceding years. In the US, Treasury and the IRS have published Notice 2019-58 concerning the expiration of temporary regulations which were issued in 2016 in regard to the debt versus equity characterisation rules in Section 385. For a copy of the notice, please go to our website or app. And now for this week's treaty developments. And another very slow week. Where have all the treaty negotiators gone? All we've had is one protocol signed. I have 3 articles for you this week. The first article is called The Guilty High Tax Exception, The Good, the Bad and the Ugly. It's written by Chetan Vagholkar and Eric Horvitz, and it's published in the Tax Notes International Journal. The article starts by giving this background. On June 21, the US Treasury issued proposed regulations related to the global intangible low-taxed income rules as part of a broader regulatory package. These proposed regulations included a highly anticipated guilty high tax exception, HTE, election. The guilty HTE was included at the request of many taxpayers who pointed to the legislative history of the guilty rules, which indicated that no residual US tax would be owed on guilty to the extent their controlled foreign corporations were taxed at an effective rate of 13.125% or greater. As everyone now knows, this turned out to be incorrect for most taxpayers because of expense allocation under sections 861 and 864. As the title of the article indicates, the authors describe some good, bad and ugly aspects of making the HTE election. In regard to bad, they discuss no cross-crediting, loss of QBAI, Qualified Business Asset Investment, and a possible adverse impact in regard to the Section 163J interest expense limitation. And in the ugly category, they discuss the loss of exempt earnings and profits, and a possible problem with hybrid dividends. The second article is called Reflections on India's Corporate Tax Rate Cuts. It's written by Mukesh Bhutani and Taran Jain, and it's published in the Kluwer International Tax blog. As you know, the government announced major reductions in the income tax rate for domestic companies on the 20th of September. In introductory comments, the authors described the tax cuts in this way. These changes are in line with the recent spate of measures unveiled by the government to address the perceived economic stagnation and induce economic growth. The extent of the change, however, is profound and fundamentally changes the ways companies do business with or in India. An important change is in the relationship between the tax rates for domestic companies and foreign companies. The authors write this. Also noteworthy is that there are no corresponding changes in the tax rate for foreign company or branches. They continue to suffer tax at 40%. Even if the dividend distribution tax of 15% is factored, ownership of Indian company is not a tax inefficient choice compared to foreign companies operating in India. Put differently, upon holistic consideration of the relevant variables, there is a disincentive to operate under a non-residence model for companies doing business in India. It is speculated that this change alone shall force foreign bank branches to look at converting into subsidiary form. And the third article is called Nash Bargaining Theory and Intangible Property Transfer Pricing. It's written by Benjamin Satterthwaite and it's published in Tax Notes Today International. This article proposes a transfer pricing framework for unique intangibles which integrates the economic fundamentals of John Nash's bargaining theory with the realistic alternatives language of amended sections 367D and 482 of the US Internal Revenue Code. The author provides this background. In classical game theory, the bargaining problem describes the ubiquitous scenario of two players negotiating over the apportionment of something desirable. John Nash's bargaining theory models the outcome of this scenario by providing an algorithm that calculates the most efficient allocation of utility between the bidding parties relative to their respective alternatives to entering into the transaction. The outcome is unique in that it provides each player with the largest apportionment of utility possible without harming the other party. In this way, the solution to Nash bargaining theory effectively gives each party to a negotiation the fairest split of benefits. Tax authorities confronted with this same problem in the transfer pricing context have tried to address it by circuitously defining an appropriate allocation between related parties as what would result from independent parties negotiating at arm's length. The voluminous statutes and regulations giving shape to this arm's length principle rely primarily on subjective comparisons with similar exchanges and fail to give the taxpayer any objective measure of a transaction's adequacy. Nash bargaining theory may be able to satisfy tax authorities' need to objectively measure the merits of transactions, and it may provide much needed clarity to this pressing issue in global commerce. Well, that's the way it is this Friday, the 18th of October 2019. The ITB team will be having a well-earned one-week break. We'll be back full of life on Friday, the 1st of November. Until then, I'm Steve Towers. Have a great weekend.